This video is about the Awesome Oscillator. So if you can, I want you to disregard everything on the chart other than the Awesome Oscillator, which is this series of red and green histogram bars on the lower panel, and the center panel, which contains the price bars. Now, the Awesome Oscillator was presented by Bill Williams in a book called Trading Chaos back in 1995, and it's the centerpiece or one of the essential elements of a complete trading method called opportunity trading. And what the Awesome Oscillator is, it's a histogram representation of a 5-period and 34-period moving average. The 34 period is subtracted from the 5-period. And when the histogram bars are above the zero line, it means that the 5-period is higher than the 34 period. And when the histogram bars are below the zero line, it means that the 5-period is lower than or beneath the 34-period moving average. So you can use the Awesome Oscillator as a quick trend reference. When it's above the zero line, conditions are generally bullish, and when it's below the zero line, conditions are generally bearish. Now, the Awesome Oscillator does not by itself provide trading signals, and I think this is an important concept. We want to use the Awesome Oscillator conditions that get created as what I'll call take or pass conditions. It sets up a number, an exact number that you can use to determine whether you want to take the trade or pass on the trade if indeed the next bar following the condition meets our criteria. But there's only 3 take or pass conditions that can be set up with the Awesome Oscillator. And the first one is dead simple, and that's when the Awesome Oscillator crosses from above 0 to below 0 or below 0 to above 0. And the zero line is very easy to recognize. So we have one occurrence of that. It's a bearish cross. The Awesome Oscillator histogram bar crossed from above the zero line to below the zero line, and that created a take or pass condition. Okay, so now we'll ask the question, what is a take or pass condition? So what we want to do is we want to look at the price bar or the candle that corresponds with the histogram bar that created the condition. And because it's a bearish condition, we're now below the zero line on a red bar. The condition that we will use for a take or pass decision is if the next bar following the condition bar prints lower than 64.97. Now, a complete trading system would have filters and other aids to determine if indeed you would want to take that trade or pass on it. But that's the condition. Now, it's pretty straightforward. We'll cover the other 2 conditions subsequently here. But one thing, I think the best thing about the Awesome Oscillator is that it's totally objective. You don't have to interpret anything so far as creating the condition is concerned. And I think that can be important when you need a starting place to determine if you want to take a trade or if you want to look for a condition under which you might want to take a trade. And the other thing about the Awesome Oscillator is that if you integrate it into a trading system, you will never be left out. It's absolutely guaranteed. You will never be left out of a major trend. Okay, so we've covered condition 1, and that's simply a cross of the zero line. So let's look at condition 2. Now, in the book Trading Chaos, Bill Williams called this saucer trades. Since we're going to be looking at trades or a histogram above the zero line. These would be saucer buys. So we have a series of green histogram bars followed by a series of red histogram bars, and we'll start here. This is the first green bar following a red bar, or in this case a sequence of red bars, and this is going to create the condition. And because it's a green bar above the zero line, it's going to be a buy condition. So we want to see what price level we'd be interested in. And in this case, it's if the next bar prints higher than 64.65, do we want to take the long trade or pass on it? That's the condition that we're interested in right now. Now, as it turns out, this second bar did trade, I think. See the high, 64.59, 64.65. Okay, the second bar, or the bar following the trade or pass bar, did trade higher. Okay, let's wipe this out. Okay, then we move on. I have another series of red bars followed by a green histogram bar. We look at the candle or the price bar corresponding with it, and we get a take or pass condition with a print above 65.71 on the next bar. Okay, then we have another little series of, in this case, 4 red bars, followed by another green bar, and the green bar creates another take or pass condition. In this case, it's a print above 66.74 on the next bar. And we'll move on a little further because I think there's another example that we want to look at here. Okay, again, followed by a series of red histogram bars, one green bar. The change in color is enough, in this case, to create a condition. And the condition is a print above 66.98 on the next bar. Okay, now our single green bar is followed by a single red bar. The red bar negates the condition. It wasn't triggered, and we had a red bar. It negates the condition. But this is a good example. We have a green bar followed by this one red bar, but the single change in color, one bar, is enough to create another condition. And in this case, the condition would be to take or pass on a print on the next bar above 66.99. So the quick lesson here is that you don't need 2, 3, 4, 5, 10, or any number of red bars leading into in the green bar change in color, again because we're above the zero line. And this is the example of the zero cross, which set up the condition. So we'll do the same thing now below the zero line. We have a series of red bars, which are now in trend, followed by a green bar, followed by another red bar. So now this red bar is going to create a sell short condition. Okay, we want to look at the low. It's going to create a possible sell short condition on a print below 64.72 on the next bar. Then we'll move on. We have 3 green bars followed by another red bar, and the color change in line with the trend is going to create another take or pass condition, and in this case it would be a move or a print below 6382 on the next bar. Okay, now this sequence of bars creates, I guess, one corollary. This was our signal bar. The print price we were interested in was 63.82, but the next bar did not close or print below 63.82. It actually moved higher. Now, because the next histogram bar stayed red, we have generated another condition at a higher price, and that would now move the print trigger price up to 64.54. So now if the next bar prints lower than 64.54, we get to make a decision whether we want to take the trade or pass from the condition signals we receive from the histogram bar. Okay, we move on again. We have a green bar followed by a series of red histogram bars, followed by a series of green histogram bars in a current time. So we've looked at condition 1, which is a crossing of the zero line by the histogram bars. We've looked at the saucer buys, where we look for a change in color above the zero line from red to green, and below the zero line from green to red, to generate the take or pass conditions. Now, there aren't a lot of examples of the next or the third condition, and that's what do we do when the histogram bars change color below the zero line but in the opposite direction. In other words, can we get a buy signal below the zero line by looking at the green bars? And yes, we can, and there's one that we're going to look at here. They're infrequent, so I don't have a lot of examples. But this is how that condition occurs. We have a series of red bars followed by a green bar, a red bar, and the next green bar is closer to zero than the green bar preceding it. Okay, it's closer to zero, and you can see the this green bar got to a level of minus 131, and this green bar got to minus 1.17, both negative, but the second green bar was closer to zero. So that actually gives us a buy signal or a buy condition with a print above 64.73. And then we had two consecutive green bars after that, and then another red bar, which again negated the signal if it was not taken. I know that's not a lot of examples, but that condition is called the twin peaks. And for a situation below the zero line, the second peak, the second green bar, was closer to the zero line than the first one, and it would be exactly the same when we're above the zero line. And there is another example here where this red bar, this red histogram bar, was at 0.65, and we had a green bar between them, and this one was at 0.54, which is closer to zero than the 0.65. So this bar would have generated a Twin Peaks print condition where it would have created a take a short trade or pass with a print below 65.50 on the next bar. So I think the three conditions, they're not difficult to understand. You got to look a little bit with the Twin Peaks, and you almost always have to have colored bars, because it's just so hard to find these when all the histogram bars are the same color. But those are the conditions. We'll run about 15-16 minutes. I don't want to go too much longer than this, but this is part 1, and part 2 we'll talk about some things you can do to, I guess, correct or assist in overcoming one of the downsides to the 534 Awesome Oscillator, and that's that it can be slow to respond to very quick changes in trend. But I hope you found this useful, and we'll have part 2 coming out pretty soon.